Right now, not a single income stock on SGX clears every hard gate in this framework. If you have been searching for safe yield in this market, you have probably noticed how hard it is to find names that genuinely protect your capital while beating risk-free benchmarks. Today, we map the 4 names sitting nearest the line and what needs to change before they pass. I'm Iggy. I run the numbers on SGX stocks so retirees don't have to guess. Every income name I track on SGX misses this framework's floor by at least one measure. The furthest miss is well over 100 basis points. That gap matters more than it sounds. This video covers 4 names, the ones with recent enough data on file to make a real comparison, not a scan of every SGX dividend stock. If there's a REIT or trust you're holding that isn't here, it doesn't mean it clears the floor or fails it. It means it hasn't been through this specific screen yet. This is not a buy list. It is a map of the gap. The single most common question I receive is what dividend stocks to buy right now. A clean, perfect list does not exist. What does exist is a clear look at the names closest to clearing the bar, what stands in their way, and how to tell a near miss from a structural failure. Why the phrase best dividend stocks has no clean answer comes down to 3 tensions. We have strong operating businesses. DBS delivered a record quarter, OCBC raised payouts, and Singtel remains operationally sound. The real problem is our yield hurdle, calibrated against CPF special accounts 4% guaranteed rate plus a margin. With share prices running near record highs, dividend growth has not kept pace with price expansion. The framework is doing exactly what it was built to do. What makes a popular business and what actually clears a strict capital preservation floor are 2 completely different questions. The yield hurdle is designed to be the toughest realistic benchmark in local markets. This audit focuses strictly on who meets the standard. Here is where things actually stand across the 4 track names. DBS sits at a 4.21% total yield, missing our 4.7% hurdle by 49 basis points in Zone 4+. Parkway Life REIT sits at a 3.98% trailing yield, missing by 72 basis points with a provisional Zone 4+ rating. UOB yields 3.67% ordinary, missing by 103 basis points in Zone 4-. Singtel yields 3.03% organic, missing by 167 basis points in Zone 4-. DBS is our closest miss at 49 basis points away, at $75.57 per share. Trailing ordinary yield sits at 3.41%, while trailing total yield including capital returns reaches 4.21%. Against our 4.7% hurdle, both fail, but the total yield misses by just 49 basis points, placing DBS in Zone 4+ for a narrow single-gate miss. Why DBS sits this close comes down to trailing window mechanics. DBS has paid its raised 66-cent ordinary dividend for 3 consecutive quarters. The trailing 12-month window has finally absorbed those higher payouts. This is genuine trajectory improvement where sustained execution moves the trailing numbers rather than a one-off spike. DBS presents 2 different realities for legacy holders versus fresh capital. If you are a legacy holder, your yield on cost is likely well above current market yield, making this narrowing gap positive confirmation. If you are deploying fresh capital, you are entering at valuations where current distributions still do not clear the floor. With CET1 above 16%, balance sheet strength is not the constraint, entry price is. What a 49 basis point miss actually means is timing, not structural rejection. Our hurdle is anchored to CPFSA as the highest quality risk-free SGD reference. Based on August 2026 pricing and results, this gap can close through 2 straightforward paths: further dividend growth or share price consolidation without requiring any operational overhaul. Parkway Life REIT is our second closest name, 72 basis points away, with an important caveat. At a unit price of $4.12, trailing yield is 3.98%, trailing the 4.7% hurdle by 72 basis points. First half DPU expanded 14.6% year-on-year, but strong percentage growth off a low base cannot close a 72 basis point yield gap on its own. Parkway Life REIT carries a specific gearing caveat. Our proxy calculation puts aggregate leverage around 34% as of the 30th of June 2026, below our 35% ceiling. However, this figure derives from general debt to assets rather than MS aggregate leverage definitions. The Zone 4+ rating remains provisional until verified against primary regulatory filings. What closest does not mean is treating all near misses identically. Collapsing a narrow miss and a wide miss into one bucket defeats the purpose of disciplined screening. That is why this framework applies plus and minus zone suffixes to distinguish manageable gaps from structural deficits. Singtel carries a 167 basis point structural gap. Measuring against core organic yield, Singtel misses the hurdle by more than 3 times DBS's margin. Even if you include the value realization dividend, the yield fails the threshold. The gap is real and structural on both measures. UOB's widening gap reflects a mechanical base effect rather than business deterioration. An older, higher financial year 2024 dividend rolled out of the trailing window, while a lower financial year 2025 dividend rolled in, pushing the miss to 103 basis points. Because UOB and Singtel face gaps exceeding 100 basis points, both sit in zone 4 minus. A near miss and a wide miss tell completely different investment stories. DBS can close its 49 basis point gap automatically as the trailing calendar catches up to existing dividend declarations. Singtel requires a substantial new dividend hike or a major price pullback. Suffixes keep these execution realities distinct. One community built on one forensic lens. In volatile markets, the gap between a safe income sanctuary and a capital trap is determined quickly. While public releases review past reports, members of Iggy's elite investors review live setups, updated metrics, and early research ahead of general publication. What elite investors receive inside the private community includes 3 core tools. You get 0-day forensic breakdowns the moment filings land, full access to the red zone watchlist documenting exact constraints, and institutional cheat sheets built on our 5-layer audit. Check the description link to join. DBS's path to passing is already running on the calendar clock. 3 of 4 trailing quarters already registered a 66-cent rate. As the final lower historical quarter drops off, the trailing yield tightens mechanically without needing management to issue new guidance. Parkway Life REIT's path to passing is waiting on one specific number. On the yield side, 3.98% trailing yield is confirmed, locking in a real 72 basis point gap. On the leverage side, our 34% proxy must be validated against primary regulatory reporting before this provisional pass is made permanent. UOB's trajectory depends entirely on its next single declaration. The current 103 basis point deficit occurred when a lower financial year 2025 final replaced a higher financial year 2024 payout, despite a raised interim dividend. A higher financial year 2026 final distribution would quickly narrow the trailing gap. Singtel requires the largest catalyst to bridge its gap. Unlike banking peers, there is no automatic calendar adjustment to close 167 basis points. Passing requires a material increase in core dividend distributions or significant price compression. The business is operationally resilient, but the mathematical spread remains wide. The floor does not move to accommodate market prices. Lowering yield standards when share prices surge turns a risk framework into an echo chamber. The 4.7% floor stays fixed against CPFSA to protect retirement purchasing power, ensuring disciplined capital allocation regardless of market optimism. Where this leaves your portfolio depends on your capital mandate. A 49 basis point miss on a bank balance sheet carries a fundamentally different risk profile than an over-leveraged balance sheet failing on debt service. Investors with long runways can evaluate trajectory differently from retirees drawing immediate income. The honest answer is that rigorous analysis prioritizes capital safety over comforting buy lists. Names sitting close to the line are near for distinct mechanical reasons, while wider gaps reflect structural yields. Understanding the specific gap is how you protect capital. I am Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a mass licensed financial advisor before committing funds.